What's up, everyone? It's Caddy with MoneyVest. Welcome on board for our live stream on the Federal Reserve. We've got the statement coming out in under 15 minutes. If you guys can see me and hear me, just give me a thumbs up. Just want to make sure the audio and the video is working well. And we are ready. We are ready. This is it. This is what most people have been waiting for from the markets. And we'll take a look at, of course, the NASDAQ, the S&P 500, the Dow Jones. Again, just give me a thumbs up if everything is working well here, the audio and the video here. The NASDAQ is down a little bit closer to 60 basis points, with the S&P down about 22 basis points as well. And the 10-year yields are trading at just under 4.6.5%. So once again, thank you so much for joining. We've got the poll going on right now. Are you expecting for the Federal Reserve, for Jerome Powell to be hawkish or dovish in today's speech? And then we'll take a look at, of course, the statement in about 13 minutes here. So again, shout out to everyone. Jeffrey, Indy, Mark, Tootie, Jeffrey again, Simran, thank you so much all for joining. I really appreciate it. And definitely do participate in the poll. Do me a favor, also drop a like on this live stream and also share this in other groups, in other places where you would want people to join. Of course, engage with us as we see what the Federal Reserve is going to do with respect to interest rates. Really, it is not about so much about what they're going to do with this meeting, but it's really going to be about the guidance that they provide us going forward in the remainder of 2024, because the markets have, of course, repriced significantly from 6 rate cuts to now as many as one, and even that is kind of uncertain, considering that there's been some probability for even a rate increase in 2024 as well. So only one rate cut being priced in 2024, and then going into 2025, we're expecting another rate decrease. So Dana says, I'd be surprised if he is hawkish with the stock market being down. So the thing is that the stock market has very little to do with what the Federal Reserve is doing, right? Yes, the markets, just a normal market functioning. I'm sure Jerome Powell thinks about the bond market, thinks about the equity markets, but that is not their main decision-making process, where they're looking at the markets and being like, okay, if the markets are down, let's just sound a little bit more dovish. No, they're really looking at inflation numbers. They're looking at inflation numbers. They're looking at economic growth. They're looking at unemployment, recession, all those factors to better understand whether it's time to pivot from increasing interest rates to making them go down, or it's time to keep them where they are and potentially even increase rates once again. So as we have already discussed in our previous videos, the Federal Reserve needs a reason. They need a reason. They need an incentive. They need something to fix with interest rates. If there is nothing broken, they're not going to change their policy. So in other words, if inflation continues to be more elevated, higher than usual, and economic growth continues to be strong, unemployment continues to be low, there is no reason for the Federal Reserve to start cutting interest rates in the first place. Unemployment numbers are scheduled for later this week. We did get the ADP employment numbers today, 192,000, so coming in a little bit higher than the consensus expectations. And then we had the JOLTS numbers coming in at 8.488 million. So if you kind of plug this number into this spreadsheet, so 8.8488, I believe it was. So if you come back, yeah, so 8.488, and then unemployed persons, we're going to get this number on Friday. So that's the first Friday of the month. We're going to learn more about what the unemployed persons are. But the bottom line is that this number continues to slide lower. This is the ratio of unemployed persons, of job openings versus unemployed persons. And this number has come down from 2.5 down to 1.3, meaning the market's becoming a little bit more on the equilibrium side with respect to job openings and unemployed persons. So the lower this number gets, the better it is from an interest rate standpoint, because that basically tells us that the labor market's kind of softening a little bit, and we're seeing a more stable and more equilibrium labor market. But of course, the higher this number is, the tighter and the more competitive and the more strong the unemployment numbers are. So we want this number to be lower, because that's only going to increase the probability of rate cuts going into the next several meetings. So if unemployed persons, for example, this Friday, if that jumps to, let's say, 7 million, then this number drops to 1.21. If JOLTS numbers increases, or actually decreases to, let's say, 7.5, and then we see unemployed persons go up to over 8 million, then you can see the ratio continues to come down. And that's exactly what the Federal Reserve and we as investors also would like to see, because that's going to really mean that unemployment is struggling a little bit, it's softening, and that's going to increase the probability of a rate cut. So when it comes to QQQ, is down about 60 basis points. SPY is down about 23, 22 basis points as well. We do have, of course, Magnificent 7, Big Tech, a little bit more mixed, with AMD dropping over 8.7% on earnings. I've got a video coming out on AMD as well, and on PayPal. Both of those companies have still yet to analyze. Tesla's down about 1.3%. My covered calls are now up over 75%. We'll be closing them out very soon. The moment they cross over 80%, I think they might already be up 80%. Nvidia is down 4.2%, down to 827. And the entire index, the Magnificent 7 index, is down about 84 basis points. At the moment, Meta's recovering a little bit. Amazon, after the earnings, up about 1.9, almost 2%. And Google and Microsoft also just up about 90 basis points to 1%. Communication services has been doing a little bit poorly. So Google and Meta pushing up higher today is going to be a small recovery, small rebound for those two companies there. So again, guys, do me a favor, participate in the poll. We got 156 votes right now. We got 8 minutes until the statement release. I want to see at least 500 votes on this poll here. So, we've got about 260 people watching. Hopefully, by the time press conference begins, we're going to have, well close to 1,000 people. So do participate in the poll, engage, comment, ask questions. If you have any questions for me, economic questions, fundamentals, stock analysis, whatever it is, I'm here to discuss that all with you. And also share this live stream. So like this live stream and also share this live stream with other people who may want to join and, of course, can participate with us as we are looking forward to the press conference at 2:30 p.m. Eastern. And of course, a statement comes out in now under 7 minutes. So hope you all are ready. This is really what the market looks forward to. Most months, it comes out about 8 times a year. And of course, most months we're looking for inflation numbers. We're looking for unemployment. If you come over to the BLS website, so bls.gov, we've got the inflation numbers next coming out, I believe. Let's see, I think next week might be when they come out. So bls.gov, anybody can go on that website. So we are scheduled for May 15th. So not next week, but the week after is when we've got the next CPI release from BLS. And as we already know, that it has been a little bit more elevated than usual. So if you come over to the charts, we have seen inflation, of course, stay more sticky than what many people expected for inflation to come down. So this has been the trend over the last, I would say since June of 2023, so last almost 1 year, it's been kind of stable at around that 3%, 3.7% mark. This is where all items sit, and core inflation, even though trending lower, but the rate of that decrease has been slowing down significantly over the last several months. So Caddy Powell, bro, no dovish is bad. Powell being hawkish is also bad. What do we do? So, if he is dovish, the thing is that I think they're now changing their tone. I shared this chart in one of my previous market updates, kind of highlighting that Powell's tone. So there was a huge December pivot back in December of 2023. If you guys remember, Jerome Powell came out and hinted that there's going to be a possibility for rate cuts in 2024. In fact, in their summary of economic projections, they also highlighted that they're expecting for 3 rate cuts in 2024. They kind of reiterated that in 2024 in the last March meeting, because that's when the meeting was. So again, in March SEP, they reiterated that, okay, 3 rate cuts is still on the table. But as we have seen in most of March and in April as well, in front of testimonies, Congress testimonies, and a lot of other press conferences and speeches, the statement and the tone has really shifted from Jerome Powell because of inflation numbers coming out stickier than usual, elevated, and not really coming down as fast as what they had expected. As well as a lot of FOMC members, voting and non-voting members, have also come out and they have been a little bit more hawkish. They've kind of changed their tone. Howard Marks and Jamie Dimon also suggesting that interest rates are going to be higher for longer, or there is a possibility that they're not going back to the levels that we saw pre-COVID or during COVID. So there has been a little bit of a shift in the overall market sentiment, and that was quite literally the repricing risk that we were talking about most of 2023, is that interest rates are very much subject to where inflation goes. And inflation, of course, is one of the leading indicators for the markets right now, even though it's a lagging indicator because we're always getting the numbers from the previous month. But really, at the end of the day, it is going to be a leading indicator because it's going to dictate where interest rates go. And the Federal Reserve is quite literally not going to pivot They're not going to shift from quantitative tightening to quantitative easing unless they feel confident that inflation is coming down and they get that slight hint they're looking for, that unemployment is going higher, economic conditions are softening, they're weakening. But if the economy stays strong, inflation's high, if I was on the Fed, if I were the Federal Reserve chairman, if I was in place of Chairman Jerome Powell, I would not cut rates, right? Would you? Would you cut rates if inflation was elevated above your target and also economy was strong, unemployment was really, really low? I mean, if interest rates were high, the economy would be showing that. And yes, you could argue that underlying factors, there are some factors you can pinpoint to the inversion of the yield curve. You can pinpoint to the PMI manufacturing index dipping below 50. There's been contraction. But on the surface, the economy is still strong. Consumer spending is strong. Earnings have been coming in much better than expectations. So there's a lot of metrics here that are suggesting for, again, a very strong economy, which seems very much resilient despite the higher interest rates. So if you were on the Federal Reserve, if you were on the FOMC, what would you be looking to do? Like, would you be cutting rates, or would you be staying where you are, or would you be interested in raising interest rates to crush inflation even further? If I was on the Fed committee, I would most likely be staying where I am, not cutting interest rates anytime soon until I actually see some signs that are suggesting for either inflation coming down very, very fast or below target, or unemployment is really starting to move back higher. But we're not getting that yet. Anyway, 2 minutes left for the statement to come out. I'll get to all the questions. Again, if you have any questions related to the markets, the economy, individual stocks, technical levels, support, resistance, whatever, let us know. Let me know in the chat, and I will make sure to go over that after we have gone over the statement. Also, do participate in the poll. The press conference is in just over 30 minutes at 2:30 p.m. Eastern. And what do you think Jerome Powell is going to be like today? Hawkish or dovish? Let us know in the chat. Do participate in the poll. And we are now almost ready to get started here. Also, do drop a like. We're trying to get to at least 100 likes by the time the statement comes out. And we'll see the live reaction from the market. So remember, from the last statement, basically there was no change. Interest rates stayed where they are at 5.25% and 5.5%. This is where interest rates are at the moment. So if we continue to see this number here, that means, of course, no change. And that is exactly what majority of the members are also expecting. Majority of investors and participants are expecting for interest rates to stay where they are. Absolutely no change in this Federal Reserve meeting. So again, in under 2 minutes, we've got the numbers coming out. So let's see what we got. 1 more minute, folks. 1 more minute. So we got the S&P 500. So we'll go over to the 5-minute chart here. We've got the QQQs over here down about 0.5%. This is the NASDAQ 100. And then we've got the SPY 5-minute chart also over here. Just under $501 and down about 21 basis points. And then we'll put the 10-year yields right behind me over here. That's going to be the 10-year treasuries, 4.6.5% at the moment. So all of them are going to be on the 5-minute chart. 30 seconds left, and we'll see what the Federal Reserve decides to do. I think it's most likely going to be as expected. Interest rates are going to be unchanged, and we're going to be at 5.25% and 5.5%. I guess so you're out of Fed. Interest rates should increase in order to avoid stagflation as it was back in the 70s, Mino says. I do agree. I think to some extent I do agree. If the economy can continue to handle higher interest rates, because as I mentioned before, it is much easier for the Federal Reserve to cut interest rates than it is to raise interest rates, right? So, but anyway, we'll come back to that. So just waiting. As soon as that statement becomes available, we will go over that and we'll take a look at the market's reaction as well here. So there we go. There's a statement. Just opening up the PDF file. And we're looking at interest rates to be at around 5.25% and 5.5%. So in support of its goal, the committee decided to maintain the target range of the federal funds rate, 5.25% and 5.5%. And considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, evolving outlook, and balance of risks. So absolutely no change from the Federal Reserve as expected. The markets are pushing higher just a little bit, not a whole lot. I mean, QQQs are back up to 423. The SPY is up back up to over 502, basically flat on the day. And the NASDAQ still down about 27 basis points. And we do have a lot of individual stocks, especially the Magnificent Seven, starting to push higher. Meta's now up 2.6. Amazon's up 2.2. Microsoft, Google also pushing up about 1.5%. Tesla is still down about 1%. Nvidia is still down 4%. But we are seeing a little bit of that rally higher after the statement release here, which is quite literally almost the same as what we have seen before. So the committee seeks to achieve maximum employment and inflation at the rate of 2%. The committee judges the risks to achieving its employment and inflation goals have moved toward better balance over the past year and keeping interest rates unchanged. And the committee does not expect it will be appropriate. So that is quite interesting. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards the 2% target. I just want to see if this is something that they mentioned last time, because I don't remember reading this in the March report. So if you come over to the statement here. Okay, so committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence. Okay, so same language there. And then reading further. Yeah, so reading further, committee will continue to reduce its holding of treasury securities and agency debt and mortgage-backed securities. Beginning in June, the committee will slow the pace of decline of its security holdings by reducing the monthly redemption cap of treasuries from $60 billion to $25 billion. So this is new. This is something that they did not mention before. In addition, the committee will reduce its holding treasury securities agency debt. As described in its previously announced plans, the committee is strongly committed. Okay, so I think that's one of the reasons why the markets are rallying quite aggressively, is because they are reducing the amount of roll-off from their treasury securities from $60 billion down to $25 billion. So that is, I would say, kind of like a passive pivot. It's not an active pivot, right? So they're not actively buying treasuries or mortgage-backed securities to create demand to push yields lower. But they're also not reducing interest rates actively. So what they are doing is that they're reducing the monthly redemption cap, meaning the amount of treasury securities that they were allowing to roll over. It's going to go from $60 billion to $25 billion. So we're going to be keeping more treasuries. They're going to be just doing that at a slower pace, which is, again, not an active pivot, not an active quantitative easing. It's just a little bit of a passive pivot here from the Federal Reserve. So that is definitely new and could be one of the reasons why the markets are rallying a little bit as they are. The committee will maintain a monthly redemption cap on agency debt and MBS at $35 billion and will reinvest any principal payments in excess of this cap into treasury securities. Let me just go over the last statement here. This was from back in March. And stance of monetary policy. Wide range of information, including readings. So yeah, I think the big shift here was mostly on the balance sheet. I think interest rates are kept the same, but the bigger shift is happening on their mortgage-backed security agency debt, reducing the cap, slowing down on the pace of the roll-off, and then also the mortgage-backed securities from $35 billion is what they are shifting now. So maintain the monthly redemption cap at $35 billion. And of course, the more important piece here, reinvesting any principal payments in excess of this cap into treasury securities. So that actually is a little bit of a pivot from the Federal Reserve, because now they're actually investing back in treasury securities. So they're coming back in with some demand, which is going to, again, keep yields a little bit more stable. And this is going to, by the way, you guys can see me and hear me, right? I just want to make sure that the audio in the video is good, because I haven't had any comments on the live chat here. Just let me know if the stream is still working. I just want to make sure there's no connection issues. So what does a treasury cap mean? So basically what happened was, as the Federal Reserve pumped a lot of money into the system, right? So they were buying a lot of treasury securities. So they were basically buying treasury debt. They were buying bonds from the U.S. government, right? So they were lending money to the U.S. government, and they were buying bonds which were put on their balance sheet. So as they are maturing these bonds, right? So they're collecting their principal payments back, right? And they're not reinvesting anything right now. So they're not really buying actively from Treasury Department, right? So they're letting these bonds expire, or in other words, mature, and they're getting the principal back. Before, they were basically had a cap of, let's say, $65-70 billion worth of bonds they were going to allow to mature, and they're going to collect their principal. Now they're reducing that cap to $25 to $30 billion. So in other words, there's going to be more bonds on their balance sheet. So the reduction of their balance sheet is going to happen at a slower pace moving forward. And more importantly, they're also going to be reinvesting. Mortgage-backed security-wise, the $35 billion, that's the cap. Anything excess of that cap, they will be reinvesting it into Treasury securities. So that, again, is a little bit of a passive pivot, in my opinion, from the Federal Reserve, which is not super active here, but it is something. It is something. They're doing something here from a quantitative easing standpoint. This is not quantitative easing. This is just a little bit less quantitative tightening, if that makes sense. So that's why I call it like a passive pivot and not an active pivot here. Okay, audio video is good. Hear you well. Perfect. Streaming is fine. Buy AMD here. So I'm actually been looking at AMD puts. AMD puts, been looking at 130 strikes, 125 strikes. We'll be sharing some ideas in the Discord because I do like the premiums. I was looking at, I think, 30 days out, 125 strike puts selling for 250. So those are some, I think, decent premiums that I was looking at. But then I'll also look at 130 strikes here. But AMD, from a buying perspective, I can't remember where I put the fair value, the nibble price, light buy price on AMD, but I think it certainly is, could be a light buying opportunity here for AMD. It's certainly not an aggressive or heavy buy, but could be something to look into from a light buying opportunity here for AMD, considering how much it's sold off. So that's where we are. For interest rates, so no change, of course, as expected, and there's a little bit of a shift in the overall tone and the message from the Federal Reserve with respect to the balance sheet that they have. Of course, it's swelled up to well over, I think, $7-8 trillion during the pandemic because of significant amount of buying that they did. But let's just take a quick look on where they are. So recent balance sheet trends, total assets. Let's take a look at this one here. And so it swelled up to well over almost $9 trillion. And you'll notice that, since the last several months here, can anybody remember what this happened here? Why did we get a spike during this time? So let's see a quick pop quiz and a memory quiz for everybody here who's participating in the chat. So we were obviously seeing a reduction in the balance sheet from the Federal Reserve. It came down from 8.9 down to as low as 8.3, so $600 billion off, and then a huge spike back to 8.7 trillion. And then since, we have just seen a consistent decline here once again. But what happened here during that spike? I want to know. I want to see who remembers during that time. This was, again, of course, back in 2023. So there we go. Bank crisis, of course, Silicon Valley Bank going down, Citizens Bank. There's a lot of banks, First Republic Bank, going down. So, of course, the Federal Reserve had to step in and pump liquidity back into the market to help support these financial institutions. And, of course, the big four were very well capitalized to begin with, but it was really just the middle market, the smaller, medium banks that were struggling. So that was a spike. And then, of course, since then, we've been coming down. So $7.4 trillion is where we are. I think, again, with the statement that's been released, there's been a little bit of shift in the overall language and the plan moving forward. So we're still going to see the reduction in the balance sheet, but not at the same rate. It's been a little bit more consistent right now, but moving forward, it's going to slow down even further. So what we are going to potentially witness here is really just a sideways, like really it's going to be coming down, but it's going to be barely noticeable moving forward because they've reduced the cap significantly to amount of redemption here. So that's where we are with the balance sheet. And again, we've got less than 30 minutes now for the press conference. The markets are somewhat volatile here. We did rally a little bit after the statement. We're kind of giving up on some of those gains, but SPY is flat and QQQs are also down about 42, 43 basis points. The 10-year treasuries did drop, but they're now recovering back higher. So personally looking at Apple in the 150s and 160s. So 150s for Apple would actually be quite good. That would be the second tier support that we have on Apple right over here. But the perfect buying opportunity really would be in the 130s. I mean, 130s, if Apple gets down to 130s, that would, for me, would be like a no-brainer buy for Apple here. So, that would be like obviously down 34, 35%, which doesn't really happen that often for Apple stock. Usually it comes down like 20, 25% down. 35% sell-off, that's about a third of a $2.5 trillion company. It's a pretty significant sell-off, right? The market cap's going to come down dramatically for this. So, but tier 2 150s, and of course, load the truck, back up the truck here and load it up in the 130s here for Apple. So yeah, MJ says the key is that they are reducing the quantitative tightening. Yeah, so this is not quantitative easing. This is not the beginning of quantitative easing. This is simply just doing less of quantitative tightening. So quantitative tightening, are things like increasing interest rates, reducing the size of the balance sheet, and letting a lot of the bonds, mortgage-backed securities, and treasuries kind of expire, mature, and collecting the principal back and not reinvesting anything. So that's quantitative tightening from the Federal Reserve standpoint. Quantitative easing is actively cutting interest rates, actively buying bonds and mortgage-backed securities. So the Federal Reserve is right now doing neither. They're not increasing interest rates. They're not, selling, assets from their balance sheet to reduce the size of it, but they're also not buying or lowering interest rates. So they're kind of like in the middle, just maintaining what it is at the moment. And like I said, it's more of a passive pivot, less of quantitative tightening right now. Explain, what is the Fed trying to do with treasuries? How does the money work? And what are they trying to achieve here? So the way it works is that, let's take a look at the 10-year treasuries, right? We'll just take a very simple example. So this is the 10-year treasuries, right? Now, let me ask you this. How big is the bond market? Give me a number in terms of size. So let's say that if the equity market is 1, how many times over, how big is the bond market? Let's see if anybody can answer that question. I just want to ask a very simple, quick question. How big is the bond market relative to the equity market? Is it twice as big, 3 times as big, 4 times as big, 5 times as big? What is that number? Let me see who's got that question. So Prayer says $10 trillion. So I want to know, like, how, in terms of how many times over, how much bigger it is. Okay, so we've got 3 times, 10 times, 3 times, 3 times, 3 times, 10 times, 3 times. So the correct answer is 3 times. 3 times the global, like the bond market's 3 times bigger than the global equity market. So it's significantly bigger, right? There's a lot more players involved because there's bigger governments, sovereign funds, pension funds. There's just the amount of capital flow in the bond market significantly bigger than that of the equity market. Now, the Federal Reserve is a very major player in that market, right? Because they're the Federal Reserve of the biggest economy in the world, right? The United States. So the main function that the Federal Reserve tries to do, of course, is when they are doing quantitative easing, they step into the market and they actually start buying bonds, right? They start buying bonds because, let's say 10-year treasuries here is yielding 4.6%. They go out there, Treasury Direct, right? The Treasury Department of the U.S. government, they start buying bonds. And what does that do? That increases demand, because if the Federal Reserve is stepping in, that is increasing demand, right? If they're the ones that are buying, demand is coming in. And what happens to the price when the demand outstrips the supply? Should be a pretty fairly simple question, right? What happens to the demand? What happens to the price when the demand is greater than the amount of supply? And if there is a lot of demand, what happens to the price? What happens to the price? Let's see. We're gonna start engaging a little bit more with all of you. So let me know what you think happens to the price when there is more demand, and if the Federal Reserve is coming in with that demand and starting to buy bonds. What happens to the price of those bonds? So let's see. Price goes up, right? So price goes up, increases in value, of course. And as price goes up, what happens to the yield? What happens to the interest rate, the yield that the bond is paying? What happens to the bond, yield, the interest rate? So as the price is going up, what happens to the yield? That's the second question. It's a follow-up question. So yeah, perfect. You guys are correct. Taylor says yields drop. Absolutely, right? So that yields actually go down. Interest rates go down. So there's the inverse correlation between price and interest rates, prices and yields. So as the Federal Reserve steps in to buy bonds, prices go up and yields go down. And that's exactly what happened, right? Yields went down. And that's exactly what the Federal Reserve also wanted. You'll notice that over here in 2020, in March of 2020, yields absolutely collapsed from 1.9 to pretty much went down to as low as 0.3%. There was an 82% collapse in the yields because the Federal Reserve was doing what? They were constantly buying. They were buying a lot. They were swelling up their balance sheet, as you can see on this chart. The Fed's balance sheet basically swelled up during this time. This was the March 2020 COVID times. You can see like it went from like 4.1 trillion to 7.1 trillion in just 3 months. in 3 months. That's the amount of heavy buying the Federal Reserve did. So that was a spike in the balance sheet because of the amount of assets. That's all the bonds that are sitting on their balance sheet. And it's pushed the yields lower. It's pushed the yields down because economy needed lower interest rates so that it can start stimulating growth once again. Lower interest rates means, cheaper financing, more growth, more jobs, more spending, more investing, all that good stuff. And that stimulates the economy. That's part of quantitative easing. Now what they're doing is whatever's on their balance sheet, they're letting it roll off. They're obviously not buying anymore, right? So they're allowing it for it to expire and mature, and they're not reinvesting the principal back. So that's why the balance sheet's been steadily coming down. And that's why I always mention what is easier for the Federal Reserve, quantitative easing or quantitative tightening. Should be a very simple question. What is faster for the Federal Reserve to do? Quantitative tightening or quantitative easing? If everybody gets this question, everybody should get this question right. What is faster for the Federal Reserve to do? Quantitative easing or quantitative tightening? What can they do overnight? Quantitative easing or quantitative tightening? So Taylor says easing is faster. So what is faster and easier for the Federal Reserve to do? Quantitative easing or quantitative tightening? Easing. Absolutely. 100% correct. Easing is much faster. They can cut interest rates overnight. They can start buying bonds overnight, but they can't get rid of them overnight. They can't raise interest rates overnight. They have to follow that process because they cannot surprise or shock the economy. So easing is faster. Easing is easier for the Federal Reserve. So that's why they like to take their time. That's why Jerome Powell has constantly mentioned that we're going to wait until it's the very last moment that they feel confident that, okay, now we need to ease. Because they've worked all these months to raise interest rates. They've done a lot in quantitative tightening. They don't want to get into a situation where they cut interest rates and then they have to increase interest rates again because they did not finish the job. So that's why it's really important. That's why I mentioned the risk of cutting too early is far greater than the risk of cutting too late, because the recession can always be handled later. Inflation getting out of hand cannot be handled that easily. So anyway, that was a bit of a longer discussion from a macroeconomic standpoint, but let's see here. Cutting rates to zero. Yeah, we did see a lot of money printing during 2020, 2021, right? There was a lot of money being printed, and of course, the Federal Reserve continues to buy bonds here. But anyway, the market's non-reactive. I would say there was slight shift in the Federal Reserve's statement. I think that's really what's going to be the primary focus from a lot of the media. And they're going to be asking questions related to the balance sheet roll-off, the runoff, policy here moving forward, and of course, the path for inflation and interest rates from Jerome Powell. But QQQ's down about 40 basis points. SPY is basically flat. Yes, I will be doing a video on Amazon and AMD earnings as well. I have a lot of earnings videos to catch up on. I did Tesla earlier today. I will be doing PayPal. We'll be doing Amazon. We'll be doing AMD. And then, of course, we'll be covering, I think Apple's reporting next week, or is it? Let's see. I think Apple might be today. May 2nd, tomorrow. So tomorrow after the bell is when Apple is reporting. And yeah, I mean, we've had this discussion before. We had this discussion back in 2022. I asked you guys a very simple question, that of all the Magnificent Seven, which company do you think will cease to exist in 10 years' time? Which company do you believe is not going to be around 10 years from now among the Magnificent Seven? Among the companies, the largest, the biggest of them all, which company do you believe is not going to be around in 10 years' time of all the Magnificent Seven? So there's Google, there's Microsoft, there's Amazon, there's Meta, there's Apple, there's Nvidia, and there's Tesla. Which company do you think is not going to exist? If there is going to be one that may not exist in 10 years' time, which one do you think it'll be? So Mark, thank you so much. I appreciate that. Great show. One of my favorite stock talk YouTuber guy. Keep up the amazingly awesome work, brother. Hit the like button to support Caddy. Thank you so much, Mark. I really appreciate it. So we got Tesla, Facebook, Apple. Really, that's quite interesting. We got Tesla, Facebook again, Nvidia. Wow. Don't say Tesla. We got Apple, Meta. They will all be there. Lee says. There's a lot of overlap, right? There is a lot of overlap for a lot of these companies, as we've discussed. Amazon, Meta, Google, they all compete in advertising. Amazon, Google, Microsoft, they compete in cloud. There's been speculations for electric vehicles being launched by Apple. And of course, Tesla is doing that. A lot of companies are now starting to produce their own chips. Meta's also, competing with Apple on virtual reality and metaverse. So there's a lot of overlap here. But the interesting thing is that I'm seeing a lot of apples. I'm seeing a lot of apples here. And the thing is that 2022, I asked the same question. Most people said Meta. Most people said Facebook, right? Facebook would cease to exist. That's because Facebook was absolutely down. The stock was just getting crushed. It was selling off left and right. It was down at $80 a share. And everybody had lost hope on Meta. They thought that Facebook is dead. TikTok's going to rule the world. And that's it. That's the end of Meta. So it's kind of interesting that, we kind of do a very similar survey 2 years later. And now it's not, I see a few Metas, but it's now between Tesla and Apple. And both of those companies, I would say they're strong. Their financial positioning is very strong. Their moat is very strong. But because of the trend, they're both underperforming this year. Tesla's down like 30% year to date. Year to date, 27%. And Apple, I think, is also underperforming the S&P. It's down how much? 8.6%. Both of them are really struggling this year. And I'm seeing a lot of Apple and Teslas now. But really, I think the question, if you kind of break down and look at it from a perspective of which company is the most complacent or which company is the most resistant to change, which company do you think it is? It's not about which can be easily replaced or which doesn't have a moat. It's really about which company is not keeping up with the trend or which not keeping up or not trying out new things, or is really a little bit more complacent. One company I can tell you is never complacent, and that is Amazon. I think Amazon's always trying out new things, always trying out new projects, new products, new services, always trying out and learning. I think that's in their culture, is to fail often, fail regularly. I think another company, maybe not Meta, but Mark Zuckerberg, always trying out the new trends, right? What's going to be the next big thing? Always trying out new things, not complacent. So I really don't think that Meta or Amazon could fail in the next 10 years because of their culture of always trying new things. They're just not complacent and trying the next big thing. But yeah, Apple, I don't know. I feel like it's been the same phone for a lot of years, and they really need to come up with something new. Like they need to come out with some new products and services. But yeah, Apple and Tesla, people could argue. But Tesla has, again, new things coming out, FSD and whatnot. But I don't know. Yeah, a better question could be, which company could we live without, right? Which company could we live without? But they're all so integrated. Pretty much every day we're using, apart from Tesla, I would say every day we're using, one of those 6 companies. Anyway, so we got 6 more minutes. For the Federal Reserve to start talking, Jerome Powell to start talking. Everyone, please make sure that you drop a like, subscribe to the channel, and also do comment. We got 483 votes. We're trying to get to 500, so 15 more votes on what you think Jerome Powell is going to be, hawkish or dovish today in his tone for the press conference here. Mark says, I believe Tesla, with all their innovative companies in the future, will be the most valuable company of all 7. That's good analysis. Tesla and Apple have viable products for long term, in my opinion. Meta's paper product can always be threatened by next bigger social media giant. I agree, but so I agree how it's like more software, more online versus hardware, but it's not that easy to create the next big social media giant, right? It's not that easy. Meta's worked on this for decades to get to where it is, where now WhatsApp, Instagram, Facebook, Messenger, those are some of the biggest apps, right, that people use. Literally not a single day goes by without me using WhatsApp. right? Or Instagram. So, you know, I get where you're coming from, but and then again, I feel like there's less of complacency in Meta than there is in maybe say Apple, I would say. Mark says I would never bet against Apple. Apple is like in and out, keep it simple. If it ain't broken, don't fix it. Yeah, I mean, imagine if Steve Jobs were still alive, Apple would be different today. Yeah, it would be. It would be very much different. Could be even more successful, could be less successful. We just don't know, right? We'll never know. Man United will be gone. So when you have too many phone companies, you're not regularly coming out with something new. Chances are you will lose your market share quickly. And perfect example is BlackBerry. That's true. I mean, one of the things that Apple's done really well is that, again, Vinod mentioned, if it ain't broken, don't fix it. Or Noel mentioned that, right? So if it ain't broken, don't fix it. So they've just been kind of recreating what's already been working. And that is definitely a big recipe for success. But how long are they really going to go on for, right? I mean, at some point, we are going to pivot away from the phone to something else, right? We're going to pivot away. I mean, the smartphone's been going on for like well over 25, 30 years. And I think eventually we are going to pivot to something else. Unless I'm just thinking too much. But I do believe that there is a possibility where there's glasses or there's smaller technology that we use for doing everything, basically. So Meta will keep having a fight with the law in different countries. Yeah, I mean that's another thing that we got to deal with, right? Anyway, so we'll get ready for the Fed meeting in about 3 minutes here. QQQ is pushing higher now, almost flat. So what I'll do is I'll of course put the QQQs up top on the right here. SPY is going to be at the bottom right, and then we'll put the Fed meeting in another tab here. So there we go. Live streaming, Federal Reserve. Boom, I think it should be this one. Let me just bring it up very quickly. And then I'll do an audio check. Just let me know if everything is working well. Almost there, folks. Almost there. Just getting started here. Joe, yes, options are also included in everything on that. So we'll do an audio check here in about a minute, 30 seconds left. And hopefully you guys are able to see and hear everything, and then we'll... Dustin says the smartphone is capped with growth and functionality. It's primarily use knows mind-numbing apps. Yeah. So market's pushing higher. QQQs are starting to recover a little bit. So basically flat now. Again, I'm going to do an audio check. Just give me a thumbs up if everything is working well. Just give me a thumbs up in the live chat, okay? There we go.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs to workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored.
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Thanks for taking our questions, Chair Powell. I wonder, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Would that be a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things. But if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts. And those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%. And another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December and that caused an uptick in activity, and that caused inflation. Presumably that's what, or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of conference. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path than a 2% inflation. That's the signal that we're taking.
Steve.
Yeah, Mr. Chair, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view. I think that, in fact, we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. And I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
No, I wouldn't say that. No, I mean the active tool of monetary policy is, of course, interest rates, and this is a plan we've long had in place to slow, really not in order to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Torres from Bloomberg. Two questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. We didn't get, our confidence in that didn't increase in the first quarter. And in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation, and this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it. And that's how we think about that.
Claire.
Hi,
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It would be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up. And of course, he's Mr. Potential Growth, our star. Do you share that view? And would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year for that matter too. So I think in that case, I think you really do have a significant increase in potential output, but you've also got more supply, but those people also come in, they work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward. Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria. Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Simon.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but it, you know, in the longer run, if you have wage increases running higher than productivity would warrant, and then you know there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. You were Nancy. Nancy. Sorry.
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, and but it's also in this case unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And so this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation. assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So that you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. They have their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so, we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Kyle.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly, more diverse than it used to be in many dimensions, more diverse both from the obvious, gender and demographic ways, but also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question though. Thank you very much.
All right, everyone. So overall, I think there was a lot of things that he repeated himself on because the questions were obviously very, very similar to each other. Rate hikes, rate cuts. What are the expectations? What are they looking for? Markets pushing higher, and yields have also started to recover a little bit, so back over 4.6. But the Nasdaq here up almost 1%, SPY up over 90 basis points. So of course, definitely a very, very strong move to the upside. Bottom line is, I think really what was quite interesting is that they have not seen any progress in the first half of 2024, in the first quarter, in fact, and they are essentially expecting that gaining that greater confidence is going to be a bigger challenge than they previously expected. And they mentioned that policy is still very well positioned to react and handle all different types of scenarios. And one of the things that we already mentioned in the statement that we discussed earlier was the fact that they have started at least some type of passive pivot here because they're reducing the size of their balance sheet, but that's going to be going down at a slower pace because they're reducing the cap on the roll-off of the mortgage-backed securities and treasury securities as well. Actually, mortgage-backed is going to be staying unchanged, but they are going to be reinvesting the excess capital into treasury securities. So that, again, is new things that they have mentioned in the statement here. And Jerome Powell, again, continues to mention, economy strong, 276,000 jobs added on average in the first quarter. Core PCE is sitting at just under 3%, and that's their goal, to bring it down to under 2%. Very, very soon. And again, we can kind of write off all the political questions because we knew that he was never going to answer any of those. So I do still have lots to break down. I will be doing that in a more separate, more dedicated video, kind of going over a summary of everything Jerome Powell said during the press conference and the decisions made and what the quantitative passive pivot means for the economy and how the Federal Reserve is going to be approaching that. So thank you so much for joining. I really appreciate you all. Markets did push higher after, of course, the conference here, starting to roll over just a little bit, but still green very much on the day. Just make sure that you drop a like and, of course, subscribe to the channel. And as always,